Hey guys, welcome back to another FinSights video. Today I'm going to be going over how to trade a bear market using a daily chart and a weekly chart. If you're unfamiliar with technical analysis, I'm going to be releasing a technical analysis 101 course on our Patreon. I've got the site up on this video so you can see it, patreon.com/FinSights. We're going to be making courses and uploading them onto the Patreon so you can understand what the hell all this means. But today, if you want to follow along, feel free. You can still pick up something. If you don't, no harm done. I'm going to try and keep it short and efficient. One reason I like to use charts is not because I'm a weatherman and I'm not trying to predict the exact movement of a price. I'm not going to be able to guess exactly where the stock market's going to go. No one can do that. So if someone's telling you that they can, they're probably lying to you. There's hundreds of professionals that have tried and they're much more educated than we are, and they are not magical gurus making billions of dollars, otherwise we'd know about them. There are a very select few that end up being extremely successful. So that being said, I like to use the charts because you can gauge risk in the market and you can gauge trends. Trends are something you can spot on the fundamental side of things. You can spot trends in a business's profits. You can spot trends in whether or not a company is accruing debt and they're struggling to turn a profit. And the nice thing about charts is everything that is known about a company gets discounted in the stock price. That includes emotions, that includes their fundamentals, that includes how many cars they're selling if it's a company like Tesla. Everything gets discounted in the price, and what I mean by that is it gets reflected in the price. Buyers will come in if there's good news, if there's good emotions, whether it's logical or not, and then sellers will come in if there's negative news and bad emotions, again, whether it's logical or not. And fear usually drives the market quicker down than good news drives it up. So that being said, I'm just going to start going right into the chart. So you can see that I've got different sections highlighted. I've got these teal little boxes here, and I've got these red boxes here. And when you're looking at my chart specifically, I like to use this as kind of like, this is a good low risk entry, or this is a bad risk entry. Red is bad, blue is good. I try and keep it really simple like that. And so when you're looking at this chart, you can kind of see where I've got my teal. It's kind of it may seem like I'm cherry picking bottoms here, but you'll understand how I got to these boxes as we go along. And then you can see my red boxes here are clearly marking tops, but that's completely coincidental. And then I've got this one amber box here, and I'll explain that later. But this is just kind of like an uncertainty area. The chart we're looking at, this is actually 1999 to 2001. I think this is a great chart to analyze because I think it's very similar to how things are right now based on the valuations of everything and how the market's been just constantly going up. So I think this is a great chart to look at to kind of compare and contrast what's going on with today. If you're watching this, in 2024 or something like that, then maybe things are a little bit different. But right now it's February 2020. It's actually February 24th, 2020. So yeah, let's just go ahead and get in. So I have a few of these little squiggly lines here. I know when people first look at charts, they think it's voodoo. It's really basic, guys. It's so this red line here represents a 50-day moving average. It takes the last 50 days of the price of the stock market. In this case, this is the S&P 500 that we're looking at. And it takes the last 50 days and it creates an average of what that price was. So you're seeing the average of that price for the last 50 days. And this yellow, gold, whatever color you want to call this, I like to call it gold. This is my 200-day. So same thing, except it's a 200-day moving average. And typically the 200-day and the 50 are very significant on the daily chart. They kind of gauge support and resistance sometimes. Support and resistance is kind of like support means the stock is going to bounce off that point, and resistance means the stock is going to come down from that point. It also can kind of gauge whether the stock market is in a bull trend or a bear trend on the daily chart. So we can see here we had what was called a death cross. So the 50-day moving average crossed below the 200-day moving average. Now sometimes it can whiplash you if you're going in and out of a trade trying to use it. So here it didn't exactly cross, but sometimes it will take that little dip and then come back up and continue on. We actually had that back in 2015, 2016, and then it continued on up and it stayed above the 200 again, the 50-day moving average did. But here we had a clear death cross or bear cross, whatever you want to call it, where the 50-day moving average crossed below the 200-day moving average. So the red line crossed below the gold line, and that kind of signals your bear trend. It doesn't mean it's guaranteed. You know, we could have bottomed right here and then continued on up. Obviously, that wasn't the case back in the tech bubble, but it's definitely a good risk metric to use as you're making these trades, and it'll make sense as we continue on in this video. So the next thing is I'm going to show you two indicators so you don't get overwhelmed on the daily chart. So up here we have the MACD. The MACD measures momentum in the market, and we're actually not even going to pay attention to this on this video in particular, but just know that we can use it to kind of support the trade that we're going into. And then down here we have the stochastics indicator. The stochastics indicator takes the previous 14 days of price history, and it gauges whether or not over the past 14 days the current price is oversold or overbought. So if we look at this chart here, I'm just going to point out certain spots here. The stochastics is telling us, based on the last 14 days, price is overbought right here, and overbought means that it is at the top of that range over the last 14 days. And then we can see here where I've got the blue highlight, or here over the last 14 days there, price is oversold. That means it is at the bottom of the range of the last 14 days. And that's how those indicators work. There's no voodoo involved. There's no magic formula that's going to magically get you 1,000% every year. It doesn't work like that. And people who tell you are gambling, and they're going to burn out within 6 months to a year. I guarantee it. Now I'm not saying you can't have really good gains. I've made 30, 40% in 2 weeks at certain points, and I've also lost $8,000 in a week on a dumb trade. So it can happen to anyone. But I've learned from my mistakes, or at least I like to think so. And just be careful when you're taking advice from some of these other people. They may have only had 2 years of experience, and they think they made a couple good trades and now they're an expert. So just watch out for that. And when it comes to charting, there's, like I said, it's not voodoo. Like I've seen some pretty crazy comments about technical analysis and how it's like, you've got a dragon pattern and that means the stock market's going to go down 30%. It's not like that. When you're talking to a actual market technician, they're going to tell you use it to gauge risk, use it to gauge trends, and anything else is speculation. And so the way we use it to gauge risk, now that we've kind of got a premise of how everything is, and obviously these little bars here represent a day in the stock market. You can see as it's going up and down, you can kind of follow the price here. Didn't want to forget to mention that. So as we're going along, we have obviously our peaks and troughs. And one way we can kind of gauge what's coming next is by gauging the risk. And the way I like to gauge risk is use trend lines. And a trend line essentially marks the bottom of the peaks and troughs. So right here we got the bottom of the troughs, and right here we got the peaks. And this is support, and this is resistance. So this is one way of gauging your risk. When the price is near support, your risk is more limited than if you tried to enter, up here. This happens when you're new. You have the fear of missing out. You see this. You see the stock going up like that, and you're like, man, I got to get in this. And you get in, and then it drops back down. So early on, it's a common mistake, and I can't blame people. I probably did that when I was first trading for the first time, and it happens. So the way we mitigate that is we buy on support and we sell at resistance. Now that doesn't mean that we know that the next point this is going is right here, right? What I mean by that is we have, you can see this little peak right here. So let's say we bought in right here. I am going to sell right here. Yes, it went up further, but like I said, you cannot predict exactly how the stock market is going to end up. I mean, I could have bought in right here, and we could have very well just kept on going down. And when we get over here, you'll see that it's good when you're buying on support. Even if you buy in, you're still limiting your losses. But we'll get to that. So that's one way. You're buying on support using a trend line. Another way of buying on support is using the 200-day moving average. I never ever buy when there's a little bounce here on the 50-day moving average, this red line. I never trust that. I find that, I've been doing this for 7 years, and I just don't ever see the 50-day moving average as being nearly as reliable as the 200. And also you should note that support and resistance is just like supply and demand. Supply and demand means, when there's greater demand, the stock price is going to go up. When there's greater supply, the stock price is going to go down. So think of it that way. Your resistance is your oversupply. Your support is your higher demand. And the thing about that is it's never going to be an exact thing. It's never going to bounce exactly off the support. So like right here, it went a little below the 200 and it bounced up. It went a little below the 200 and it bounced up. So it's never going to be exact. That's why I like to use these little blue boxes. It's kind of like a support zone. I at least know my risk is mitigated and I'm not buying in at a peak. And that's where the stochastics comes into play. So I look for support and I combine it with the stochastics. And I'm looking for the market to be either oversold, or when we get to the bear market side of trading, I'm looking for things to be overbought. So right here you can see I combined support with the market being oversold. So right there, oops, sorry about that, right there and right there. So I've got 2 points of, there we go, we'll just draw it straight up there. So I've got 2 points here where the market was oversold and I'm near my support. This is actually a long-term trend line. It actually goes further back in the chart than is shown, but when we look at the weekly chart, you'll see that. But right here, this is exactly how you would trade this. You would look for the support, and you would look for the stochastics indicator to be oversold. So you have your demand here. You're limiting risk by entering here. And I know people will trade breakouts, which if it works for them, great, but I don't know of any famous or extremely successful investors that are trading breakouts and living off that. So what I like to do is mitigate as much risk as possible. I'm not going to predict which way the market's going to go. Like I said, it can continue down, but at least I'm mitigating my risk based on the past prices. And that's all this is doing. So I'm looking at these past prices here, and my stochastics indicator is calculating this, where it's at based on the last 14 days. And it's telling me it's oversold. So I'm trusting the mathematics. I'm not trusting Voodoo. I'm not trusting chart patterns. I'm not looking at any of that. I'm just simply gauging risk. All right. So moving on, we get to this death cross here, and I'll just leave an arrow on it and make it really thick so you can see it. This is where the death cross occurs. And I've also got this blue line here kind of indicating that. So what I like to do is, like I said, I'm entering on trades where my risk is limited. So this is on the trend line, it's on the 200-day moving average, and it's also oversold. And you might say, well, look, it kept on going down. Yes, but look at all the other times it worked. You're never going to have 100% success. It's just impossible to know exactly which way the market is going. So that's why you're mitigating the risk. So look at all these positive trades you have been able to make if you follow this type of strategy, right? You're just making these tiny little swing trades, and you're selling at the first resistance point, which I would consider the 50-day moving average in this section. So you're making all these tiny little gains over and over, and it's compounding. And so you get to this point, you get in this trade, and you're thinking, well, it's probably going to bounce again. And look what happens. It goes from about 1440 to a low of 1305 right here. That's about a 9% loss from where you entered to the very bottom of that trough. And this is what I mean by mitigating risk. You didn't lose your shirt unless you're trading, unless you bought calls or something like that where you're leveraging your position heavily. If you're trading this, even if you're 100% in with your portfolio, your max loss would have been 9%. And that's only if you sold at the bottom here. That's only if you sold right here. And so that's what I mean by risk analysis by using charts. It's not voodoo, and you're not predicting, I think the stock market's going to hit 1560 and then it's going to go down to 1400 and then it's going to go. You're not doing that. You're just simply getting in at low risk points and taking advantage when it does do the short bounces like you see before. And so what happens when you get into a bear market is you get this breaking point. The trend broke. You can see the trend broke here. You get your death cross here. So we've got two indications here. Our trend broke. Let me extend that so you can actually see. Our trend broke. And let me just go ahead and remove some of this stuff so you can see. So we have our trend here, and then the price drop below. That means our trend line is broke. That means we're below the 200-day moving average, which is typically the long-term support. And we're also getting this death cross here. So we know at this point, when we get this death cross, our risk is much greater on the long side. So now we want to start thinking about taking little short positions on inverse ETFs if you're trading the overall market. And the way we do that is, you can see I've kind of flipped these teal boxes. Now they're at the top, right? They're not red anymore. Red would be down here, right? Like I've got down here on my indicator. So now we're looking at these points here, and we're taking our short position here, right? We've got resistance, which you can just think of it as the inverse of support at this point because we're in a downtrend. So we've got our resistance here, so price is likely to bounce and go back down. And we're also looking at our indicator, so it's overbought. Overbought plus resistance means it's likely to bounce down. Now, there's nothing saying that it won't go up, and when I show you the weekly chart, you'll see, obviously we end up recovering. It doesn't go on forever, but we know right now the 50-day moving average, this red line here, is below the 200-day moving average, that is a good signal of a bear market. So we're buying inverse position or a short position at resistance, and the market's overbought, and then we're going to sell at the first point of, in this case, it's going to be support because we're trading the inverse side. So I would probably sell somewhere around there because we had a bottom here. So I want to trade before we get to this point, and then I'll wait until my next opportunity. You could try and trade this, but like I said, I don't try to trade off of the 50-day moving average. I think it's good for gauging your trend, but I don't think it's good for any trade signals. And then we wait until our next signal, and then we enter our inverse position here, and we look here, it's overbought, so our risk is mitigated. Sure, it can go up, but our risk is much more mitigated than if we tried to short here and then it went up and it never came back. So we short there, and we're also going to exit that trade at the first point of support in this case. So as we're going down, we got another point here. We get our inverse position. We trade until maybe it touches this 50-day moving average, and we're just taking these small little gains and we're compounding over time. And that's how you would trade the daily chart in a bear market. All right. So next thing is the S&P 500 still. This is a weekly chart, very similar. So this is trading a bear market on the weekly chart. All right, so you can see that trend line I had drawn. This is kind of the same time period. This is 1996 to 2004. And we have our trend line here. This is our support line, right, when we're in an uptrend. The 50-week moving average follows the 200-day moving average very closely. So the 50-week moving average is my red line, and then this yellow gold line is the 200-week moving average. Typically, I don't pay a ton of attention to it, but it's good for some kind of primary trends, depending on the stock you're looking at. It does kind of match up with some trend lines. So that's the only reason I include it. You can ignore this green and red. Actually, I'm going to take that off for you right now, just so we can clean this chart up a little bit. This is just another support and resistance indicator I like to use, but it's definitely not necessary at all. Okay, so as we're looking at the weekly chart, again, I'm really mostly just looking at two indicators. This time, instead of the MACD, even though I have it on here, I'm not really looking at it. I'm looking at the RSI, the Relative Strength Index. And what this tells me is whether let's just show you here so you can get this little box out of the way. It's gauging the strength of the market, and it's also kind of telling you whether it's overbought or oversold. And on the weekly chart, it's a little more reliable. So when the stock market has these little downturns here, let me move these boxes here, you can see it turns red, and when it's doing well, we've got these little green marks here, and usually it can stay up there for a while. So I don't, again, kind of like the MACD on the daily chart, I don't try to use that too heavily, but it is nice to confirm some of your entry points. Again, we're mitigating risk. We're trying to get in at the lowest point that is relative to the past few days, or in this case weeks, and we're trying to sell at the first sign of resistance. So we're compounding our gains over and over. So as we're looking here, I'm going to start marking. We got support here, we got support here, we got support here, we got support here. And you see it bounces off the trend line as it goes up. I'm not going to mark every single one, but you get the idea. Obviously, you don't know. So let me go ahead and do something here. If you are trading, you're not going to see this. You're obviously not going to see ahead, right? So if you're trading, what do you think you're going to do when the market is up here, right? You're going to trade right there. That's going to be your entry. You've got, well, actually, it'll be right here. If you're oversold on your stochastics, which it works on the weekly in the same way as the daily chart, and you're buying on support. You're mitigating risk, right? You don't know what's going to happen, but you're taking that first little gain that you get. Let me change the color so you can see it. You're taking that first little gain that you get and you're selling at the first sign of resistance, which would be this peak here. And then you rinse and repeat. So as we get higher, you're mitigating your risk, and you can see it kind of got oversold here, but you can see the trend broke too. So in this situation, that's why I have this kind of amber highlighted box here. It dropped below. It's not completely oversold yet, and there's no signs of support right here. So I'm waiting until this point, and I have it highlighted. And again, like the daily chart, you're mitigating risk. I bought on support here, right? It's oversold. But the trade didn't work in our favor this time around. We lost from the entry point to the very bottom of this is about 10%. So again, you're not losing your bag or the shirt on your back. You're mitigating your risk when you made that entry, right? And so you can plan to exit if you lose a certain amount of percent. I am personally against stops. I would have traded this to where I would try to set a limit order to break even and then cut my losses at maybe 10%. And I'm also not 100% allocated in a trade like this. And that's a whole different way of mitigating risk. But right now we're just entering at low risk entry points. And so again, when things start to flip, when the trend starts to flip, you can see I've got these teal boxes at the top now. We're buying the inverse at resistance. Instead of buying on support for the long side, we're buying the short side on resistance, right? And that's all you're doing. And you can see this last time here, let me fix this box here. So this very last time here, we went to short here, right? We're overbought, we're against resistance, and we're taking our short side. And the stock continued up. And it actually, if you go on, you can tell this is the bottom right here of the tech bubble. And we're not going to know that ahead of time. That's hindsight. And so we're going to trade this exactly how we would trade this point, right? We're going to try and mitigate our risk. We're not going to be 100% allocated. And we're also buying in at a point that is not at an extreme. So since we're trading the short side, which means we want it to continue down, right? Let me clean up some of these zeros. We want it to continue down when we're on the short side. We mitigated our risk. So it went this way, right? So we want to be as close to the top as possible. And right now, the top to us is this resistance line. It's this trend line here. And we're following the trend of the market until it breaks, and it broke right here. And so if I change this chart here so you can see up to 2005, it continues up. And now we've got this bull cross on the weekly chart. So price is above the 50-week moving average. This is a weekly chart, don't forget. And as price is above the 50-week moving average, that's typically the sign that we've started another bull market. You can see price stays above the 50-week moving average, and then it stays below the 50-week moving average on a bear market. It's not always going to be perfect like this, but this is a great trend indicator, and all we're doing in the market is we're just trying to follow the trend. We're trying to compound these small gains, so we're buying and selling, buying and selling, buying and selling. And we're compounding those gains over time to get much higher returns than if we just bought and held. So I know that was a little longer than I maybe anticipated, but if you find this informative, please go subscribe to the Patreon, patreon.com/Finsights, where you're going to go way into depth on the technical analysis side of things. It's going to be from pretty much no chart knowledge to as much as I can teach you. And I'm going to try and make it a full month course. So it's going to be not quite 30 days of content, but I'm going to do my best to provide you as much value as possible. And if you get in right now, you're going to lock in the $10 tier. as members start to follow in. The cutoff is 50 members to get the $10, and then after that, from 50 members to 100 members, it's 20, and then 100 to 500 members, it's going to be 30. So it's definitely an incentive to get in early. We know we don't have the courses up yet, but it's definitely worth locking in. And I really hope I can provide people value, and you can learn from my mistakes. And we have a team that's going to be producing content. We're going to be writing blogs. We're going to be talking about personal finance, how to save better. Not necessarily everything is going to be about trading. It's, some people don't want to micromanage their funds. So again, we're just going to do the best to provide value to everyone. And the best way of doing that is subscribing to the Patreon and supporting the cause. And hope you like this video, and have a good night, and good luck in the current market.